2 weeks ago, I asked you to watch one number with me. Today, that number just ran into a second one. And together, they answer a question a lot of you have been asking in the comments. Should I still be buying SCHD at this price? Quick note before we start, this is for education, not personal advice. I'm not a licensed advisor, and the numbers here come from public sources. So please check them yourself before acting on anything. Here's what's been happening. SCHD has been sitting near its highest price in the past year. On its own, that sounds like a red flag. But a higher price only tells you half the story. The other half is what you're paying for that price compared to what the companies inside the fund are actually earning. That's the part almost nobody is putting on a screen right now. Most of the commentary you'll see on a new high just reacts to the number on the chart. Up is good, up is bad, pick your framing. Without asking what's actually driving it. That's the gap this video is here to close. SCHD is currently trading at a price-to-earnings ratio. That's sitting reasonably close to where it's spent most of the last several years. Not stretched into extreme territory the way a lot of new high headlines might make you assume. On PE alone, this isn't a fund trading at some outlier premium. Here's the piece almost nobody is showing you. Flip that PE ratio over and you get the earnings yield. What the companies inside SCHD earn every year relative to the fund's price. Compare that to the 10-year Treasury yield, the number we've been tracking together. As of this recording, the earnings yield is running meaningfully above the Treasury yield. A real cushion, not a razor-thin gap. That's worth knowing, because the headlines about SCHD hitting new highs don't mention it either way. This isn't the first time dividend funds like this one have faced pressure from rising long-term yields. Back in 2022, rising rates pushed dividend stocks down hard for the same basic reason. When a safe bond starts paying close to what a stock fund earns, money drifts toward the safer option. Right now, the gap hasn't closed the way it did back then. That's worth sitting with for a second because it means the SCHD is expensive, don't buy narrative some corners of the internet are running with doesn't fully hold up against the math. Layer one more piece on top of this. Payout growth for SCHD has slowed from the pace we've seen in 5 years. It's still growing, not just at the clip it used to. We flagged this slowdown before it fully showed up in the numbers. So here's the full shape of it. Price near a high, payout growth cooling, but the risk-free alternative still not eating into the fund's earnings yield cushion the way a lot of people assume. None of this means SCHD is completely without risk. The fund is still on track for its 15th straight year of dividend growth. It still holds around 100 different companies, built around quality screens and not hype. This is a much narrower question. Is today a good moment to put new money in, not whether the fund itself is sound? Here's something else worth knowing about what's actually happening inside this fund right now. The top 10 holdings make it a sizable chunk of the entire portfolio. And healthcare names, Abbott Laboratories, Amgen, Merck, United Health, currently occupy several of the very top spots. Healthcare as a sector is the single largest slice of the fund right now, ahead of any other sector. That means a meaningful chunk of SCHD's near-term performance rides on how a handful of healthcare names hold up, not the full 100-plus names evenly. When one sector carries that much weight, a slowdown specific to that sector can pull on the fund's growth more than people expect from something marketed as broadly diversified. This is worth remembering the next time someone tells you 100-plus holdings automatically means you're safely spread out. The label says diversified, but the weighing underneath it tells a more concentrated story. Remember the two holdings I flagged a few weeks back as running tight on cash flow, even with the overall valuation picture looking healthier than the headlines suggest? That specific concern hasn't gone away. Keep watching their next earnings report. That will tell you more than any headline about the fund as a whole. Picture two versions of the same investor. One bought SCHD when the PE was closer to its long-run range, and the 10-year sat lower than today. The other is deciding whether to buy the same fund right now, at a higher price, but still getting paid a real premium over the risk-free rate for taking on stock risk. Same fund, same long-term story, different starting points, but less different than the priced for disappointment framing would suggest. Neither investor is making a mistake just by existing at a different point in time. The mistake only shows up if one of them ignores what the price is actually telling them. Let's make this concrete with two paths forward. Investor A keeps adding a fixed amount every month no matter what the PE ratio says, treating today's price the same as any other day. Investor B pauses new contributions when the fund trades meaningfully above its long-term average PE and adds more aggressively when it drops back toward or below the average. Neither approach is wrong, and both work over a long enough timeline. But Investor B is the one who actually benefits from a video like this one, because the whole point is knowing which environment you're buying into, not guessing blindly every month. So what do you actually do with this? If you already hold SCHD, nothing changes for you today. Keep collecting the dividend, keep letting reinvestment do its job. If you're holding cash and waiting to buy in, the valuation math right now doesn't argue for waiting on the sidelines, the way it would if the earnings yield gap were actually thin. It argues for staying disciplined and watching the healthcare concentration, not for panicking about price. The distinction matters because a lot of people conflate the fund is at a high with the fund is overpriced. And those are two different claims that call for two very different reactions. Buying in smaller pieces over the next few months is still a reasonable way to smooth out your entry point. That's true in any environment. But the "this fund is stretched and about to disappoint people" story doesn't hold up against the actual gap between what SCHD earns and what a Treasury pays right now. Here's something you can do right now that actually helps. Look up SCHD's current PE ratio today, the day you're watching this. Compare it to what I just said. Then check today's 10-year yield and today's earnings yield on the fund. Reply to this video with just two simple words, still buying or waiting it out. Depending on where you land, I'll pull the most common answer next week and we'll talk about what it tells us about how this audience is actually behaving right now, not just what we say in theory. One more thing worth remembering, the Fed's next meeting isn't until mid-September, so that headline is quiet for a while. The real signal in the meantime isn't a date on a calendar. It's this gap between what SCHD costs and what it earns, sitting right next to a Treasury yield that hasn't caught up to the fund's own earnings power the way some people assume. Most people scrolling past a new high won't think twice about it. You now know to check the math underneath it first. If this kind of number-first thinking is what you came here for, hit subscribe. Keep Investing Simplified means exactly that. The real signal, not the loudest headline. Thanks for spending part of your day here. I don't take that lightly. I'll see you in the next one.